Hi guys, welcome back to my channel. Kelvin here. So it has finally gone up. And no, I don't mean the GST. That one is a different story. Instead, I'm talking about the Fed raising interest rates. And normally, whenever people hear about interest rates going up, they'll be like, oh no, my portfolio will be red rate now. Technically, it's already red rate if you own Alibaba or RK ETF. But that's not what I'm going to talk about today. In this video, I want to find out what's the effect of the Fed raising the interest rates, will it cause a recession, and how will it affect your portfolio. Then finally, I will share what you can do going forward. But before I start, I would greatly appreciate it if you can help to tap the like button. In return, I will show you a monkey playing with ducks. Alright, let's start right now. So on March 17, the Fed had just finished its meeting, and one of its members said, one does not anyhow raise interest rates by 100%. No one said that, it was just my imagination. Anyway, the Fed decided to raise the interest rate by 25 basis points, or basically 0.25% increase. Now, is 0.25% a lot or little? It's just a puny increase. Right before this, the interest rate was 0 because, due to the pandemic and the economy wasn't doing so well, the Fed had to reduce the rates to stimulate the economy. But before that, the interest rate was around 2.5%. And if you look even further, the interest rate almost reached a godlike 20% in the past. So right now, this 0.25% interest rate hike is just a tiny increase. But before I go any further, here's a question. What exactly is the interest rate? I keep hearing it here and there. Can it one? Basically, the interest rate is referring to something called federal funds rate. The federal funds rate is the interest rate that the banks have to pay when they borrow money from one another. Huh? What you mean? Banks need to borrow money one man? I thought they're very rich. They can afford to pay Gupta-san $13.6 million more. Okay, here's why. Whenever you deposit money into the bank will take the money and lend it out to someone else, right? But at the same time, they can't lend out everything. Otherwise, if you go to ATM and withdraw money tomorrow, they might not have enough money to give us. So, banks are required to keep a minimum amount in their reserves. For example, TD Bank keeps around 17%, Goldman Sachs 14%, and so on. But sometimes, some banks may end up not having enough in their reserves. So what they do is they borrow the money from another bank to make up for the difference. And because they are borrowing money, they will have to pay an interest rate, which is called the federal funds rate, which right now is the 0.25% interest rate. Okay, yeah? So right now, why does the Fed want to raise the interest rate? The simple answer is inflation. So due to the pandemic, businesses were shutting down, GDP slowing down, unemployment went sky high. The Fed had to reduce the interest rate to stimulate the economy, aka promote spending and borrowing. But right now, due to reasons like higher pent-up demand, supply shortages, higher labor costs, inflation has gone up to a godlike 7.9%. So no, it's not PAP's fault that your egg has become more expensive. That's just the inflation. And because the inflation has gone up too fast and furious, the Fed wants to raise the interest rate to slow it down. Here's how it works. Interest rates go up, which leads to cost of borrowing going up, which leads to company raising prices to cover the cost, which leads to you spending lesser money on stuff like Pao Cha. And when this happens, consumer demand will go down, growth will slow down, and finally, inflation will go back to its 2% target. So here's the million-dollar question. What's the effect of rising interest rate on the stock market? Will the stock market crash and 97% will lose everything after 2022, like what the rich dad poor dad guy shouts every day? Not really. If you look at the market, right when the news came out, everything was super green. Even the Hong Kong market, which was dropping like grapes, suddenly gave a godlike 5.8% return in one day. Why? The simple reason is uncertainty. Last November, when the Fed said that they will raise interest rates soon, stocks were crashing left and right. Netflix was down 50%, Snapchat down 60%, Peloton down 77%, because paper handlers will always be paper handlers. But now, everyone knows that the Fed will only raise interest rate by 0.25%. There's no more uncertainty. They'll be like, oh, 0.25% only Che, easy peasy. But wait, that's not all. In the next few months, the Fed plans to raise the interest rates 6 more times this year. So now, what does this mean for our stocks? If you look at past data, since 1990, there have been 5 rate hike cycles. And interestingly, in the 5 rate hikes, there have been only one time when the stock market gave negative returns. All the rest was super duper green. Here's another one. Right after the Fed raised interest rates, in the first 3 months, 50% of the time the market gave positive returns. Then in the next 6 months, the market gave positive returns 75% of the time. And after 1 year, the market all gave positive returns because stonks. And if you look at the interest rate chart, the long-term trend has actually been going down. This suggests that the market is already used to this kind of rising interest rates. Now, the other thing that we hear quite often, when interest rates go up, financial sector tend to do well because they can earn more money on loans. And growth stocks in the tech sector will do badly because borrowing becomes more expensive for them. Here's what the data says. When interest rates are going up, the top performing sector is surprisingly the technology sector, and other sectors like energy and consumer discretionary, while sectors like financials, real estate, consumer staples gave the lowest returns. But why? That's because interest rates are typically raised when the economy is doing well. Like right now, the number of job openings is going up, employment rates have gone up, everyone's pay have gone up, except for you and me. People are spending more money, companies are earning more money. And in this kind of environment, high growth stocks tend to give the highest return. But there's still one more important question. Will we enter into a recession? In one of my previous videos, I show you a few indicators that a recession could happen. Like whenever oil prices have gone up, recession happen right after that. Or when the yield curve inverts, a recession will happen. Or when inflation is too high, a recession will happen also. But here's what the Fed said during the announcement. The probability of a recession in the next year or so is not particularly elevated. All the signs point to a strong economy, one that will be not only to withstand, but certainly flourish. This means that not only that the Fed feels that there won't be any recession, the economy would even do well even if they raise the interest rate. So all is well, right? Not really. That's because the inflation is still high. It has been found that stocks tend to do badly when inflation goes up. For example, when inflation goes down, market goes up. Inflation goes up, market goes down. Inflation goes down, stock goes up, and so on. The recent 7.5% inflation was already high, and that is before Putin go and disturb Ukraine, leading to even higher inflation and commodity prices going up. Thank you, Putin. And talking about the war, Bloomberg has predicted 3 scenarios for the war. If the war stops, the market will go back to all-time highs. But we know that isn't going to happen because Putin hasn't accepted Elon's one-on-one fight yet. In the second scenario, the war continues on for a while longer because Russian tanks are getting stuck in the mud. Or in the third scenario, the war escalates because Putin is getting more and more desperate, in which case the market will immediately crash, then recover back, assuming there's no World War III. Right now, nobody knows what will be the outcome, only fuck God knows. But I expect the war to continue on for a while longer, which means that commodity price will remain high and that the inflation will remain high all the way into 2023. What should you do? Okay, here are a few things that you can do. First, avoid high interest debts. We know that interest rates will go up this year. This means that loans will become more expensive. If you have any high interest debts, anything higher than 4%, like student loan, credit card debt, renovation loan, chop, pay it off. If you are taking a house loan, take the fixed interest rate loan. Right now, the rates are all below 2%, which is super duper cheap. You won't see this kind of rates once the Fed raise the rates even more. Second, continue investing. Even if interest rates go up, or the recession might happen, or the war might go on, by not investing, you will confirm plus chop, lose money. Inflation at all-time highs just means that your money will lose its value faster than your sergeant's armor can run. Singapore's inflation rate right now is at 4%, which meant that your money just lost 4% of its purchasing power. By investing your money, yes, you could lose money in the short term. But if you look at history, the stock market doesn't care about any inflation or recession or wars. It has always gone up no matter what. As the saying goes, God buy, God hope. Joseph Carlson also pointed out that software companies have become a lot cheaper now. In his video, he showed this chart. This chart looks at software as a service company valuations, specifically enterprise value divided by the next 12 months revenue. The higher it is, the more expensive is the stock. You can see that right after Fed reduced the interest rates in March 2020, the valuations have gone from 10x to 20x. But after all the sell-off in November, the valuations have started to come back down to pre-pandemic levels. So right now, stocks are definitely cheaper than last year. During this period, take the chance to sell away all your bad stocks and start investing in good stocks, stuff like Google, Apple, or even Tesla, if your heart can take it. Consistently dollar cost average no matter what, and over the long term, you'll be alright. Anyway, that's all for this video. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.